Welcome to my channel. My name is Tim Sutherland. In this video, I'm going to go over a loan estimate. Decided to start a series on actual loan estimates, and I'm going to do it over the course of the next year from different states. Part of why I came up with this idea is just going online, sites like Reddit and whatnot, and people talk about, well, what are my closing costs going to be and such and such? And a lot of people reply, oh, you can expect 3%, 4%, 5%. Not the most accurate thing. Partial wish, because some of the fees involved don't necessarily work straight up and down as a percentage of your purchase price, kind of flat, and others do. So it can skew that percentage off regularly. For example, the one I'm about to get into is in Maryland, and it actually worked out to about 2.6%. So in this particular loan estimate, this one's going to be for Maryland and Montgomery County. Now, for Maryland, the county's important because each county has different tax rates, and each county has different transfer tax rates, both. So it will vary, depends on where you're buying in Maryland. So in the loan estimate, you have the lender up here. This is us. We're in Annapolis, Maryland. It's going to have the issue date. In this case, this one was issued on the 4th of January. Today is the 8th of January. It's going to have your name, your address, and the property that you're buying as a purchase estimate. It will have the loan term. You're going to look for that. Is that the number of years of the term that you like? Purpose is a purchase. You're buying a home, so it should say purchase. And then your product. It's either going to be a fixed rate or it's going to be an adjustable rate. Look to see which it says. If it does not say fixed rate, it's going to say ARM or adjustable rate, means your loan can change. And then there's your loan type. It's either going to be conventional, FHA, VA, or other, such as rural housing. And conventional doesn't break down to whether it's conforming or non-conforming. Conventional conforming being Fannie Mae, Freddie Mac, what most people refer to as conventional, but also non-conforming, which many people refer to as jumbo. Loan number, loan ID, whatever your lender has your loan number for. And then your rate lock. You want to look there. If you think your rate is locked, it'll say yes if you think so. If it says no, you can think it's locked, but it's not. And you want to talk to your lender, find out why isn't my rate locked, or arrange to have it locked. Now, if you're working with a loan officer that said you're locked and you get one and no is checked off, I'd question that right away, before you get too deep into things. Conversely, some people don't want to lock right away. Now I got a client thinks, well, I think the market was off today and I'm going to wait a couple days to lock in because I think it'll get better, and that's fine. Once you lock in, you'll get a new loan estimate sent to you. Make sure that the date on the rate lock is sufficient. For this particular loan estimate, this client was closing the end of January, so lock through February 2nd is sufficient. Check the sales price. Is the sales price accurate? Your loan officer is going to read your contract, review everything with you, make sure they understand everything that's going on and you understand everything that's going on with your contract. So make sure the sales price is right. There are times it might not be. Maybe an addendum, changing the price wasn't sent to your loan officer and they think the price is one and it's something different. So you want to make sure that's accurate. If it's not accurate, you want to make sure you get another one of these that is accurate to follow up. First section is your loan terms. It's going to have your loan amount. In this case, it's a 5% down loan. So the loan amount was $878,750. Can this amount increase after closing? It should say no. That's what you want to look for. If it says yes, you possibly have a negative amortization loan. Those loans have pretty much gone the way of dinosaur. So I would be very surprised if anybody ever sees yes on this one. And then the interest rate. If you are locked in, is that the correct interest rate? So you want to check on that. Talk to your loan officer in terms of rate. In most cases, most lenders, once you lock in, it's an up-down scale, which means you've locked into all the day's pricing for that fixed rate loan. Sometimes it doesn't come across between fixed and ARM. So again, each lender is different in how that's carried out. I'm bringing it up because let's say this client locked at 3%, which was offering a lender credit, and they decided, well, I'd rather pay a little and have the lower rate. Well, then you can just switch it to the lower rate and switch it from lender credit to points. So assuming this is accurate, you want to go to this line. Can it increase after closing? No, it's a fixed rate loan. If it says yes, you have an adjustable rate loan. But if it says yes, it should have some additional verbiage over here about it. And your monthly principal and interest, this figure is what pays the loan down itself. It's going to be based on the rate, the loan amount, and the term. If it's a fixed rate loan, it'll say no. If it's an adjustable rate loan, it will say yes. It means it can change. Prepayment penalty, make sure you do not have a prepayment penalty. If you do, talk to a loan officer, find out the ramifications of that prepayment penalty, make sure you are okay with that. Balloon payment also should say no. Balloon payment is when you have usually some giant payments in the middle that are well in excess of your normal payment. Most cases, it's going to be no. Some underserved rural areas may say yes. And if it does say yes in any case, find out what that balloon payment is. Now, it should be in the disclosures, but you want to make sure you understand it, you're comfortable with it, and you got a backup plan to make sure you're financially able to handle it. Then you have a section of projected payments. Now, in this loan, it carried it into 2 blocks simply because of the private mortgage insurance. If you're 20% down, don't have PMI, it'll just be in 1 block. It'll say years 1 through 30 or years 1 through whatever the term of your loan is. Principal and interest, you'll notice it's the same all the way across. That means all 30 years, that principal and interest will not increase. It's going to stay the same, possibly lower, if you are able to and eligible to recast. That is one situation where the payment could get lower. Next section, this client opted for monthly mortgage insurance. We have the monthly mortgage insurance here, $132 a month in this particular case. And at some point in the first 1 to 8 years, that mortgage insurance will drop off, assuming there's been no egregious change to their situation. In other words, it's still a primary residence, and they've been making all their payments as agreed. I'm just summarizing that part with the PMI removal. There's additional requirements, and the laws and regulations do change. But eventually it goes away in this particular case, and that's why you have nothing here. Now, this client had several options on the private mortgage insurance. Like I said, this one opted for monthly. They could have also paid it instead as a lump sum at closing. There's a calculation for that, or premium. Or they could have financed the loan in the loan. And there's 2 ways to do that. You can either finance it in the loan amount, which wouldn't be an option on this loan because it's 5% down. But if they were putting more than 5% down, they could. Or you finance it in a rate, as it were. Then you have your estimated escrow. And it says estimated because that can't change. We all know property taxes, home insurance can and do change. So it's assumed they will. And most of the time when they change, they go up. So in this case, we got all this here. Total month estimated monthly payment, $4,516. Drops a little here because the PMI goes away. But the reality is we don't know what the escrow will be on that. So by the time the PMI goes away, the escrow may be higher, which means probably won't see that significant of a change in the payment. And then we come here. This section will have your estimated taxes, insurance, and assessment. This one loan only has property taxes, home insurance, and it says in escrow. So yes, it's going to be here. Sometimes the numbers are the same. If it says no, it means you're paying them on your own. Other isn't checked on this one, but if it were, It's usually for homeowner association's fee. And it would say, if it was checked off, it would say HOA fee. And it would say no over here because HOA fees you always pay on your own. You don't include them in your payment. So if you had an additional, this figure may be higher than this one. This section just summarizes what we're going to hit on the next page. Estimated closing cost right here, which is your loan costs, which means not just the lender fees, other loan costs, other costs, lender credit, estimated cash to close. This particular client's a negative number just because of the size of their earnest money deposit. Then you're going to have a section, closing cost details. So that's your origination charges. The first one, section A. Many of the stuff you read about online, whatnot, say, look at section A. And for the most part, that's accurate. If you're trying to compare one lender to another, assuming at the same rate. So you have origination charges. This is going to be the total of everything in this block. Now, sometimes you'll have origination fee and origination charges. Those are two different things. Origination fee could be one of several fees, could be the only fee. Origination charges is simply the total of block A. And I bring that up because sometimes lender go, we don't have an origination fee. And maybe you're paying a half point or something to get that rate. And you go, well, I thought you didn't have an origination fee. This is origination charges. It's different. Anyhow, if you are paying points, they will be listed here if you're locked in, and it's there. If you're not locked in, lenders are not always going to put the points or lender credit in until you do. I don't. Some lenders do. But until you finalize those terms, I leave that section blank. Once you do, we fill it in. To that extent, that's only if you're not locked. Obviously, if you're locked, if you're paying points, they will go here. And you'll see the dollar amount there. You may have additional charges, application fee, lender fees, origination fee, underwriting fee, processing fee. Each lender has different names for whatever they put in here. So really, you're just looking at the bottom line part there. Then you're going to have section B. I'm going to go over this a little bit, starting with the appraisal fee. The appraisal fee, can't really use that as a comparison from one lender to the next, especially since COVID. Over the last year and a half, coming up on 2 years now. This is January 2022. Appraisers are charging more. They're backed up. They're bottlenecked. Take your pick. So fees are kind of a wild, wild west with them. So it almost doesn't matter what you put lender in. For example, in this case, for Montgomery County on home purchase prices in hot 900 range, the market price for appraisal fee, in other words, what's considered a market price, is $625. But we're not normal times. So I added $200 to it. And each loan officer is going to handle this differently, including with my own company. But in my case, I added $200 to it, collect $825. The appraisal is going to come in. It's going to have the bill from the appraiser. From a regulatory standpoint, your lender cannot keep anything beyond that. So it doesn't matter if they collected $2,000 from you and the appraisal is $500. All they can charge you in the end is $500. Means they got to give you the rest. So in this case, the appraisal comes in at the market price, $625. I've collected $825. You're going to get credited the $200 back. Some loan officers try to play a little bit of game with that one. They'll put the appraisal fee low. I had somebody send me one from Miami. Appraisal fees are even higher. And a loan officer put $300 for the appraisal fee, which I knew wasn't happening. I haven't seen a $300 appraisal since about 1996. But it doesn't matter because here's what will happen. They're going to order the appraisal. Appraiser says, I want $800 to do this appraiser. They go, fine. They just move the fee up, send you a new loan estimate, and they keep moving forward, with the new appraisal fee. Appraisal rush fee, you may or may not see that. In our case, that's a boilerplate item we put on there just in case we have to offer additional incentive to the appraiser to try to get it back to us quicker if things are taking a while. Obviously, it can't be charged if it's not incurred, which means it would just go away. if it's not incurred, or if the appraiser goes, okay, I want $100 for rush fee. Well, if you hit close, you're only going to pay $100, whatever the appraiser's extra charge is. And you got credit report, which is self-evident, and then your undisclosed debt report. That's something we have. Other lenders may handle or call it something different. Basically, it's their quality control during the process, monitoring your credit, just making sure you're not picking up additional liabilities along the way. Some loan officer may just lump it in with the credit report fee or call it something else. They're all different. Now, what additional charges you may see in here depends on your lender. Some of them are getting wise to everybody checking box A and going, here's the lender fees, and they try to look a little lower. So they'll reduce their lender charges from block A and then just start calling them some other fees that are allowed to be in block B, like tax service fee, flood fee, spend, anything else. So if you see it in there, additional charges in there, they may in fact be part of that lender's origination charges. The next section is going to have title charges. And these are for, again, Montgomery County, Maryland. Now, when you get to that section, do not assume your loan officer has the fees in from your title company. By the time you've gotten under contract, you'll have spoken with some title company, selected one. And even if you have provided the name and contact information of that to your loan officer, they will not necessarily use that on your initial loan estimate. The reason being, if they use and list your title company on the loan estimate when they start, they're bound by those charges within a 10% tolerance. They may not even know what they charge. Title company may not even know your lender, and in the end charge something else, and also your lender's on the hook. So instead, here's how it works. Your lenders has title companies they're familiar with, or they may even have an ownership interest in a title company. If they have an ownership interest in a title company, they're going to disclose the title fees for that title company possibly. And if you actually use that title company, then there's no variance allowed. In other words, the final fees from that title company have to be the same or lower. Or they're going to provide you with the name of a title company of a list they keep. And there's a 10% tolerance allowed on that, which means it can't go up more than 10%. So do not assume that Section C title fees and the Section 8 owner's policy are accurate. Now I'm going to skip down to the bottom. If you want to find out if it's the title company you're using or not, if those fees are from that, just go to the very end. And you're going to see the service provider list. And it's going to show you the title company that your loan officer used in creating those title fees. And if it's not your title company, that's fine. Because as you get closer to closing, they'll eventually have the fees from your title company and they'll update it on your closing disclosure. So it's not something to worry about. Just be aware of it. And if it's not the title company you're using, do call. Make sure you understand what your title company's charges are. An additional charge, I don't have it on here because we don't require it. Most title companies don't. But you may see a survey fee in there. Or the other part is call your title company. They're going to require a survey because you may not need one. Like I don't put one on here because we don't require it. But every now and then a client picks a title company that does require a survey. And then we get the end, and all of a sudden there's this other $400, $500, $600 charge. And they're looking at me, the lender. It's like, we don't require it. You picked a title company that requires it. Take it up with them. So be sure to ask about that when choosing with your title companies. Now, if they do require a survey and you're good with that, you have two ways to order it. You can either ask your title company to order it, or you can find one yourself and order it and then send it to your title company once you have it. So now we're getting into the other costs. And these costs from your county. These particular ones are from Montgomery County, Maryland. Recording fee in Maryland for primary residence runs about $60 for the deed, $60 for the mortgage. Yeah, it's $120, cushion $10 there. Then you have your transfer tax. Each county in Maryland has a different tax rate. Now, the state of Maryland is at 0.5%. And then each county, it can vary. In this case, Montgomery County. This client is not a first-time buyer. If they were a first-time home buyer, then that state 0.5%, the seller would normally pay half of that, 0.25%, and then the buyer's portion would be waived. In this case, it's not because they already own a home in Maryland. And then the documentary stamps. All the other counties in Maryland outside of Montgomery charge their county rate. Now, the rate itself varies from county to county, but whatever the rate is, they charge for the entire purchase price. Montgomery County has a two-step system. They're going to charge $9 and change for the first $500,000 and $13 and change for anything above that. And that's per $1,000, your purchase price. And then it's going to show your half of all of that right there. Generally, the transfer taxes are split. Check your contract to be sure. Every now and then, there's a different agreement. If you're a first-time home buyer, here's where it gets confusing, especially if you haven't been advised on this. You're online, you're reading, hey, in Maryland, it says that if I'm a first-time home buyer, the seller pays all of this. Great. But the rest of it says, unless you can negotiate otherwise. And just about every contract I see in Maryland, they negotiate otherwise, and you're still paying half, except you still waived on the Maryland portion. You're going to have prepaids. Now, most loan officers, when it comes to the home insurance section, because you do have to get home insurance, the figure, we don't know what your premium is. Me, I make the figure up, and I tell my clients it's fiction. It's not a quote. It's just the number I threw in there. I'll pull it out of the top of my head. Other loan officers may, when they do it, go, I just always use X percentage of the purchase price and throw that on there. Yeah, whatever the case, it's still fiction. Call your insurance agent, and you want to line up your home insurance within the first few days after you're in a contract. Call your insurance agent, get that rolling. And these are the reasons. Number one, your lender needs to know the actual premium because that's part of your debt to income ratio. So you don't want to have that figure be a lot higher than you were expecting, and all of a sudden, your numbers are out of whack. Number two, your lender has to approve the home insurance, make sure the coverage is acceptable. In most cases, if you talk to your lender, talk to your loan officer, or talk to your processor. Most cases, they're looking for guaranteed replacement. That's not always called that, but the gist of it is they're looking for a policy that will rebuild the house if it burns to the ground. And that's the coverage that you need. So what's going to happen here, your first 12 months, you want to ask your loan officer, when do I pay this? Now, some of them are going to want you to pay it prior to closing. Others allow you to pay it at closing. If you pay it at closing, it means it's going to be part of your final closing costs at closing. If you pay it prior, you'll still be on your closing disclosure. It'll just show POC, paid outside of closing, already paid. If you pay at closing, here's what people don't always realize. It's not your lender that's paying it now. It's your settlement agent. So if a week or two after closing, you get a call, letter from your insurance agent going, hey, where's our premium? Call your settlement agent. Find out when they sent it, has it cleared, whatever the case may be, have them track it down. I'm saying that if you pay it at closing. You can have prepaid interest. You can pay interest from the day you close to the end of the month. In some cases, if you're closing at the beginning of the month, they may do what's called an interest credit, and you'll see a negative number. It's pretty rare. Or if you're closing the first of the month on most loan types, it's just zero because mortgages always due on the first. So if you close on the first, well, it's just zero. In this case, this loan's closing the end of January. So there's about 1 day left of interest to cover the remaining day. And then the first new payment will be March 1st. If they were closing in February, first payment will be due April 1st, and so forth. Then we have the property taxes here. I could have put that here or down lower. Just to be clear in the illustration, I put it here. What this is the prorated property tax bill. Maryland runs on a fiscal year from July 1st through the following June 30th. So what that means in this case, this seller has already paid the property taxes through June 30th, 2022. Buyer has to reimburse him for that portion of it. So it's going to be 5 months, actually 5 months and 1 day. But the loan estimate doesn't allow fractions of property taxes toward there. If you don't see your prorated property taxes in a forward-looking state such as Maryland from your loan officer, they're already shorting you out on there, and you can expect to pay more at closing. As mentioned, it's going to be in here, or it's going to be down in the bottom right, and I'll get into that when we get there. Make sure loan officer's got the taxes accurate as they can be. Maryland's pretty easy. Every county, quite frankly, you just do a web search, type in the county name, property, and then the word property tax search. You'll find it. Plug in the address you're buying, and you can get the tax bill. Then you're going to have an escrow account. I'll leave that just like that. So home insurance, again, the fictional figure. Now, some people go, why are you charging me twice for this? Or they look at that and go, oh, I must not have that as part of my payment for the first few months. No. It's going to be part of your payment right out the gate. We're collecting 3 or 4 months, depends on the lender and where you fall into the different cycles of home insurance. And it's toward when it's for renewal next year. This is the current year, 2022 through 23. Comes up for renewal again in 23 to cover through 24. Start with 3 or 4 months. Add to it each month with each payment. Got enough to pay it next year. Monthly mortgage insurance generally is not escrow, so you won't see anything there. And then your property tax bills mentioned. Look up the taxes. Make sure they look accurate. Loan officer certainly knows how to look them up to that extent. Don't always go by the figure on the MLS. It's only as accurate as whoever typed that number in. Personally, I always go by the county website. So in this case, the property tax bill current is $579.28 a month. And for January closing, we'd collect 5 months. Say we were closing in February, then we'd collect 6 months. Of course, as this figure goes up, this figure would go down because you're getting closer to the end of that tax year. So it still would work itself out right there. But make sure they're showing enough in there. One thing some unscrupulous loan officers will do is they'll just put ridiculously low numbers in the escrow because they can change that willy-nilly. It's not subject to any cures or tolerance levels. Right there. Now, one thing that a loan estimate won't capture, which actually reduces your closing costs a little bit, is the aggregate adjustment. You'll see that on your closing disclosure. You may have seen it on the fee worksheet from your loan officer. And what that is, in most states, you have a 2-month cushion you're allowed, some states less. And they do a forward look the next 12 months called an escrow analysis. They're looking at what's coming in and what's going out over the next 12 months in a 2-month cushion. And if any figure goes above that 2 months, they got to give it back to you as a refund. So they give it to you as a credit. That could be 1 penny. I've seen it up over $1,000 or anywhere in between, but it never carries to the loan estimate. So as a consequence, that can offset you a little bit right there. And we already covered title fees here. You may see other fees in here, capitalization fee for buying a homeowner association, things like that. Just check what they are. It only holds, I think, up to 5 fees here. So if it hits the 5th fee and just says miscellaneous, talk to your loan officer, find out what those other fees are. I'm sure they're happy to go over them with you. And then you get down here, it's going to have your total closing costs. So it's everything added up brought here. Now, this particular loan had a lender credit. That's the other thing when you look at your lender fees, make sure you look at the lender credit that's offsetting them. Before you just dive too far in another direction. So do you have a lender credit? This one does. And it offsets those. So at that rate, there was this lender credit. It's usually rate dependent. Higher the rate, bigger the lender credit. Start moving the rate down. Eventually, the lender credit disappears and you move into points. Then you're going to get into calculating your cash to close. So you're going to have total closing costs here, which is carried down from up here. Closing costs financed, if any. Now, what that'll be is if you're financing your mortgage insurance, or in some government loans, you're financing whatever their premiums are. You'll see that here. Your down payment, in this case, is 5%, worked out to $46,250. Deposit, how much deposit did you put? Don't worry if the figure is not accurate. The amount that you gave is not going to disappear. It all gets accounted for during the process and credited at closing. I like to make it accurate, but sometimes it's not for various reasons. The loan officer may just look on the contract. It says you give an X deposit, maybe give it a different deposit. Conversely, maybe you just put a different deposit on your application. Loan officer didn't go back through. It's a minor item. Don't worry about the accuracy of it in that case. Seller credit, if the seller's paying anything toward your closing cost, or if they're given a concession, or which would end up increasing your down payment in most cases, it would go there. And then you have adjustments to other credit. And remember I was talking about the property taxes? This is the other place that tax proration could go. If I didn't put it here, I would have put it here, adjustments to other credits, and it just would have been in as the prorated tax bill. In order not to muddy the water on the other credit in there, that's why I put it in the top part. Made it easier for the client to understand the difference. This adjustment on this client is a real estate broker rebate. This rebate is real estate agent is giving toward their closing cost. So if whatever amount your agent's giving you, you may find it listed here. If you are getting a rebate and you don't see it anywhere, talk to your loan officer, make sure they know it's coming. It's not always in the contract. You usually have to ask the clients if they're getting one or not. And you want to make sure that when you are getting a rebate, your lender knows about it right up front. It's not an item can always be remedied at the tail end. It has to be accounted for during the process. And then you end up with your cash to close. In this case, a negative number just because of the excessive deposit, but pretty much everybody else, it's a positive number. It's what you're bringing the cash to close, plus whatever figure things aren't on there. As mentioned, termite reports, home inspections, whatever else you get that you haven't paid for yet. Then you're going to have additional information about the loan. So I'll list your lender and their NMLS license number. I have your loan officer, and I have the contact information. One thing, and I want to cover it while I'm on here, and I've got another video on how to look it up, is when you're talking to different loan officers, and that can be more important than the lender himself in some cases. Check the NMLS number. If it's 1 through 6 digits, because they were issued in numerical order, your loan officer's been doing this at least 10 years. It means they got it, they licensed right when the NMLS first came out. When you get into 7 digits, it's a little different then. You know, over time it rolled into the 1 million figure. About 3 years ago, it covered, I think it hit about 1,750,000. A year ago, it hit 2 million. So if you see about 1.9 million, 2 million and up, they're pretty new. Dealing with somebody who's very new. And you can just go to NMLS consumer lookup and using that license number, see how long they've been in a business, what their job history is. If it's somebody new, do they have a finance background, or were they a busboy or a barista last year? I recently had one client, looked it up and said, you know, loan officer they deal with it, they said didn't seem to know what she was talking about. Well, they found out until 6 months ago she was a receptionist. No lending business whatsoever. So it's very important. Make sure you're dealing with somebody that has the experience and the know-how, especially when you purchase. Yeah, because they say you don't know what you don't know until you need to know it, as it were. They say it, I say it, somebody says it. Then you're going to have your comparisons. So this is a 5-year comparison on this loan, how much we've paid in principal, interest, mortgage insurance, and loan costs right there. Because many people statistically aren't going to keep a loan more than about 5 years. It's probably a fairly accurate number to look at. And this is how much principal you'll have paid off in that time. APR is a cost calculation. It's not your payment rate. In this case, is 3%. APR is a cost calculation over the life of the loan, assuming you make the minimum monthly payment required. And the way they calculate it is they take your loan amount, they subtract some of the closing costs, the ones that refer to prepaid finance charges. It's not all of them. And then they reverse amortize your loan back into that figure, principal and interest back into that. And that gives you an APR. Now, if this loan did not have PMI, they actually have a lender credit. The APR would be almost the same as the 3% rate they're getting. It might be like 3.002 or something. So the bigger the spread, the more your costs in relation to the note rate. In this case, the PMI pushed the figure a little higher. But if you're talking to lenders, look at that spread, and that kind of gives you an idea of just how much you're really paying to get that rate. Total interest, basically the interest over the life of the loan divided into what you borrowed. Not really the most useful calculation, but when they came up with the loan estimate, they threw that in there. Other considerations, the appraisal. Appraisal can be ordered. Rare case, you may have an appraisal waiver. You're going to have an appraisal waiver if you're getting a conventional conforming loan. You might be eligible for an appraisal waiver. And a conventional conforming means your Fannie Mae, Freddie Mac loans up to your conforming loan limits in wherever you're buying. This country, that's in the mid-600s, some areas a little higher. If you have a waiver, you might not see any appraisal shown in that section. If you're buying a home and you come up with appraisal waiver eligible, you still have the option to get an appraisal should you choose. So talk to your loan officer about that. Do you still want an appraisal or not? That is an option that you have available to you. Just every other loan type, you are going to have an appraisal. Assumption. Most loans are non-assumable, so it means somebody else can assume your loan if you choose to allow that. In most cases, it's not. There are a couple exceptions to that, even on a conventional conforming loan. Fannie Mae and Freddie Mac allow it under a limited set of circumstances involving family and estates. I'm not going to get into details in it, and of course, the rules always change. But should it ever come up, you'll want to contact your servicer to see if it's applicable to your situation. Other than that, if you sell the home, loan gets paid off. Home insurance, loans are always going to require home insurance. If you're in a flood zone, they're also going to require flood insurance. And on that note, even if you're not escrowing, you'll always have to escrow flood insurance. It's a requirement. And then there's the late payment. I did another video on that. But the gist of it is your mortgage payments, pretty much with all lenders, are going to be due the first of each month. And then it says if your payment is more than 15 days late. A lot of people forget to read the word more. So to begin with, it's due the first, which means the second is 1 day late, third is 2 days late, so forth, which means 16th is 15 days late. No late fee yet. The 17th and on, you got a late fee. Most states, that will be 5%. There's a couple of states, I think it's just a flat dollar amount, or the percent may change. So just take a look and see what that late fee is. And then just make sure you make your payment. Before then, you don't have a late fee. Now, if you're 30 or more days late, which isn't really stated on here, that'll ding your credit. Refinance. This is basically telling you refinances are not guaranteed. Prior to the bubble, unscrupulous lenders would give you bad terms and then go, oh, well, you can refinance in a few months and get out of this. And people found out, no, you can't. So this is basically telling you that. No. Obviously, if conditions are good, rates are lower, you got equity, you want to cash out, whatever. If it's a good situation and you can do it, great. But nobody can guarantee the future in that regards for you. And then servicing. Most lenders are going to transfer servicing. Even the ones that keep your loan may transfer it to that extent, even if they may keep it for years. At one point, I worked for a bank, serviced their own loans. Every now and then, for whatever reasons, they would bundle a bunch of them up and sell them. Not often, but they would do it. So just goes to tell you, even the ones that keep their loans don't always do it. Some of them undersell the loan itself without selling the servicing. So that's why it just stresses servicing, not the loan. If you get a Fannie Mae or Freddie Mac, basically a conventional loan, conforming, you're going to get a letter after you close. May say, Fannie Mae has bought your loan. It just means they bought the note because they don't service it. So keep following your loan officer's instructions in that regards, or any notifications you get. Once servicing's transferred, you'll get letters from the old lender and the new lender. And I'm not going to cover it in this video, but you have some rights in regards to that gap as to where you make your payments and what they can do. Confirm receipt. So generally, the first loan estimate is in with your application itself. And you do want to sign it, even if you don't agree with everything on there, because it'll keep things moving forward. By signing it, you're not bound to that loan estimate to a certain extent. So in other words, as it says here, you're just saying, hey, I received that. A lot of lenders, some lenders won't even require you to sign it. Basically, they know when you opened it, and so they know it's delivered, worst case. But they prefer the signature, keeps things clean and smooth to that extent. If there are items on there that do need to change, maybe you wanted a different rate, something like that, or you want to make sure you're locked in, that's fine. They'll send you a new loan estimate. Do not hold up signing your application waiting for that change, because generally any changes moving forward don't trigger out an entire new application package. You get a new loan estimate, period. That's pretty much all lenders are going to be like that. They're not going to keep sending you new applications. So the loan estimate firm's term. If your application, say in this client, the application said 3% on it, because you're going to put one rate on that app. They go, well, I prefer 2 7/8 and maybe pay the quarter point or whatever it was that day instead of 3 with the lender credit. Okay, we're not sending you a new loan application, but we will send a new loan estimate, reflects the new terms you'd like. And that's fine. The loan estimate, the newest loan estimate, always takes precedence. And I already covered this, but essentially you're going to see the service provider list with whoever your lender used for providing fees, for title fees, and maybe some other items too on there. So you can read through there. And if they're not the ones you're using, remember those fees will be different then when you hit closing. There you go, a Maryland loan estimate for purchase. So if you like my video, hit the like button. Please subscribe. I'm going to keep doing more of these. If you have any questions, leave comments below. I always answer them. Even if I'm not your loan officer, I'm happy to answer any questions that you do have. I like to help people in this regards. And I would like to help you, though. So if you're interested, then just reach out to me. You can call me, text me, email me. My contact information is below in the description, along with all the states that I am licensed in. And thank you for watching, and I hope you have a great day.